The richest people in America don't pay taxes the way you think they do. They're not running from the IRS. They're not hiding money offshore. They're simply using a system that was built to favor them. A system most people don't even realize exists. And at the center of it is a strategy so powerful, so effective, and so perfectly legal, it feels like a cheat code. It's called buy, borrow, die. The tax loophole the rich legally use to erase billions in taxes. In this video, we're breaking down how the ultra-wealthy legally avoid income taxes, dodge capital gains, and pass on generational wealth without giving the IRS a slice. This strategy is not some hidden trick. It's right there in the tax code. But unless you've got 8 figures in assets and a private banker on speed dial, you probably haven't used it. By the end of this video, you'll understand how billionaires like Musk, Bezos, and Buffett play by rules most Americans never even see. So stick around until the end, because this strategy could change how you think about taxes, wealth, and the American financial system. Most people work for money. The rich work the system. Let's start with how most people earn. You probably make money through a job. That's W-2 income, and it gets taxed hard. Federal income taxes can go up to 37%, not including state taxes, Social Security, and Medicare. Before your paycheck even hits your bank account, a huge chunk is already gone. Then there are people who invest. Maybe you've bought stocks or a rental property. When you sell, you pay capital gains taxes. If you've held it for over a year, you're looking at about 15 to 20%. Add in the Medicare surtax, and it climbs to around 23.8% for high earners. But the ultra-rich? They don't sell, and they don't live off salaries. They buy assets, they borrow against them. Then, when the game is almost over, they die and pass those assets on tax-free. It sounds wild, but this is the real playbook, and it's all perfectly legal. Step 1. Buy. The first move is to buy the right kind of assets. Not cars, not clothes, not stuff that drops in value. The rich buy assets that grow, shares in companies, commercial real estate, private equity stakes, art. These are things that appreciate, not depreciate. Now, here's where it gets interesting. They don't sell these assets, they just hold them. And as long as they don't sell, there's no capital gains tax. The stock can go from 10 million to 100 million, and the IRS gets nothing. The wealth grows on paper, but it's not taxed. This is what's called unrealized gains. The value exists, the net worth climbs, but it doesn't trigger a tax event. The rich become richer on spreadsheets and portfolio reports, but they don't owe a penny in taxes because they haven't technically cashed out. That's step 1. Step 2, borrow. So if they're not selling, how do they live? How do they buy homes, fund companies, fly private, and give away millions? They borrow against their own assets. But imagine you have $100 million in Amazon stock. You don't want to sell because that could trigger over $20 million in taxes. But if you go to a private bank and take out a $30 million loan using that stock as collateral, you walk away with cash in hand. And here's the kicker. It's not income, so it's not taxed. Loans are not taxable. You don't pay income tax on money you borrow, so now you're holding on to your assets. They're still appreciating, and you're living off tax-free borrowed money. You've turned your wealth into an ATM. Not only that, but the interest rates on these loans are often lower than average because the collateral is so strong. We're talking prime stocks, trophy real estate, and other high-value assets. It's the best of both worlds. You're rich on paper, living like a billionaire, and paying nothing to the IRS. Meanwhile, the portfolio just keeps compounding. That's real financial power. Why banks love this? You might be thinking, what kind of bank gives out tens of millions to someone without a traditional job or paycheck? The answer is simple. These borrowers aren't risky. Their assets are rock solid. We're not talking about payday loans here. We're talking about lines of credit backed by Fortune 500 stocks or luxury real estate in Manhattan. These loans are often structured with low loan-to-value ratios. That means someone might borrow only 20 to 40% of what their portfolio is worth. Even if the market drops, the bank still has plenty of security. Plus, ultra-wealthy clients don't just borrow, they bring in business. They park their wealth in the bank's asset management arm, buy insurance products, and use private financial services. For banks, these clients are golden, low risk, high reward, stable, profitable. So yes, banks are more than happy to hand over millions to someone who's not technically earning anything. What happens if the market crashes? Let's address the elephant in the room. What happens if the assets backing the loan lose value? It's rare, but not impossible. The wealthy protect themselves in several ways. First, they diversify. They're not putting all their eggs in one stock or sector. They own real estate, businesses, funds, and other hard assets. Second, they don't overborrow. If your portfolio drops by 25% and you only borrowed 30% of its value, you still have a cushion. You're not in danger of getting margin called or forced to sell. And third, they have backup. They own cash-flowing businesses, insurance policies, or additional equity they can tap into. If worst comes to worst, they can renegotiate the loan or pay it off using other assets. But more often than not, they just wait. Because over time, high-quality assets tend to bounce back. Step 3. Die. Now comes the final step, and it's the most outrageous one of all. Die. When someone dies, their heirs inherit their assets. But here's the trick. Those assets get a step up in basis. That means all the unrealized gains from decades of appreciation, they vanish, gone, erased. Let's say someone bought stock for $10 million. By the time they pass away, it's worth $100 million. If they sold it while alive, they'd owe capital gains tax on the $90 million in profit. But if they die holding it and pass it to their kids, the cost basis resets to $100 million. If the heirs sell it the next day, they owe $0 in taxes. That's right, a lifetime of gains, a fortune built on paper, and the IRS doesn't touch it. It's the ultimate reset button. No sale, no tax. Just generational wealth passed on cleanly, legally, and without interruption. What happens to the loans? But wait, what about those loans? What happens to the borrowed money? Usually, they're paid off using a portion of the estate, or better yet, the heirs refinance them. Since they've now inherited the same assets at a stepped-up basis, they can keep the strategy going. Borrow, hold, pass it on. The wealth never really leaves the family. It just shifts form from generation to generation. The tax liability? Still $0. The loans? Just another financial tool. This is how dynasties are built and maintained. Why is this even legal? You might be wondering why this is even allowed. Why hasn't Congress changed the law? The truth is, the tax code was written to reward long-term investment. Lawmakers believed that encouraging people to hold assets would create market stability. But in practice, it created an enormous advantage for those who already own appreciating assets. Ending the step-up in basis has been proposed. So has taxing unrealized gains, but neither has made it into law. Why? Because the people who benefit from this system are the same people funding campaigns, writing policy, and influencing lawmakers. It's not a glitch, it's not a loophole, it's how the system was designed. Who's using this strategy? Let's talk about some names. Warren Buffett has publicly said he pays a lower tax rate than his secretary. He's not joking. He holds on to his investments and lives off borrowed money. Jeff Bezos? He's used margin loans backed by Amazon stock to fund his lifestyle and ventures like Blue Origin. Elon Musk? For years, he sold almost none of his Tesla shares. Instead, he used those shares as collateral to borrow. That's how he bought Twitter. And Mark Zuckerberg? That massive $45 billion donation in 2015 wasn't to a traditional charity. It went into an LLC he controls. Still his money, still under his direction, still growing. This is not tax evasion, it's tax planning, and it's all built into the rules. Why you've never heard of this? The reason most people have never heard of buy, borrow, die is because it's not taught in school. It's not something your accountant brings up during tax season. It's not even something the average financial planner is equipped to execute. And the IRS? They don't advertise it either, but it affects you anyway. Because while you're grinding at your job and paying your taxes on time, someone else is compounding wealth, living large, and paying nothing in capital gains or income tax. The result? The wealth gap gets wider, the tax burden shifts downward, and most people don't even realize what's happening. The final lesson. This video isn't about jealousy, it's about clarity. The wealthy aren't winning because they work harder. They're winning because they understand the rules and they play a different game. Buy appreciating assets. Don't sell. Borrow against them. Live tax-free. Pass them on. Reset the tax bill. Repeat. This isn't a loophole. This is the system. If this made you rethink how wealth works in America, drop a comment below. If you learned something new, hit the like button so more Luxo lovers can see it. And don't forget to share this with someone who still thinks the rich play by the same rules. If you want to keep learning how the ultra-rich really live and how the system actually works, subscribe to Luxo-Life and hit the notification bell so you never miss a video. Watching is just the start. Understanding is where the real power is. Catch you in the next one, Luxo lovers.